Welcome back to Gecko Finance Channel. This is Artie and let's go. Today we're gonna talk about Dividend Aristocrats, what those are, and if it is worth investing into them. So let's get right into it. In our last video, we mentioned Dividend Aristocrats as a sort of a very special Pokemon. So let's figure out what those are. Among dividend stocks, there's a separate category of companies called Dividend Aristocrats. Well, that sounds pretty rad. What do I do to become a Dividend Aristocrat? Well, to do so, you need to increase your dividend payments for 25 years. Companies that have been increasing their dividend payments year on year for more than 25 years become Dividend Aristocrats. There are also 3 additional criteria that a company must meet to become a Dividend Aristocrat. Those criteria are: Number 1. Presence in the S&P 500 index. Capitalization of more than $3 billion. The average daily trading volume on paper is more than $5 billion. There are 64 Dividend Aristocrats. S&P maintains their official list through SPDAUDP index fund. If you don't live in the ocean right under the sea, you must know the names of these companies. By and large, there's no magic here, right? So you can see a list of well-respected big companies that have been on the market, that have been on the playground for long enough to be willing to pay their investors some good dividends. And it feels like you cannot lose if you invest in them. Yeah, but there are some peculiarities that I'd like to tell you about. Before we go any further, I'd like to tell you about another group of companies, and it is called Dividend Kings. Well, those are companies that have been increasing their dividend payments for more than 50 years. And what's interesting about them, to become a Dividend King, you don't need to meet those requirements for Dividend Aristocrats that I previously mentioned. So here you can see a list of 11 companies that are Dividend Kings that did not make it into the Dividend Aristocrats list. Those are Nordson Corp, Commerce Bankshares, Lancaster Colony, American States Water, California Water Service Group, ABM Industries, Stepan Co., Northwest Natural Holding, H.B. Fuller, SJW Group, Farmers and Merchants Bancorp. If you choose between Dividend Kings and Dividend Aristocrats, you can see that the latter look a bit more reliable because they have additional requirements to their capitalization and such. And yeah, if a company has been on the market for a long time and if it's big enough, well, you can see there's some potential there. After all, the larger the company, the more stable it is. Such companies have a high credit rating and they are included into indexes and portfolios of large funds. This is additional evidence of the reliability of the asset. Stable dividends and the possibility of their reinvestment trigger the effect of compound interest. Historical data shows that every dollar invested in the S&P 500 in 1930, without reinvestment, would have brought $115 in 2021. And with reinvestment, every dollar would have brought $3,626. Wow! Wow! And this is confirmed by their ratings, because if you have a look at it, you will find that in the list of Dividend Aristocrats, the amount of companies with a rating of at least A- is much higher than in the S&P 500. Another thing is that the dividends are higher than the market. The aristocrats make their profit through the growth of the asset itself and through dividends. Since 1999, the aristocrats have shown the average dividend yield of 2.5%, with the broad index showing 1.8%. Here you can see the comparison of the average dividend yield of Dividend Aristocrats and regular S&P 500 players. Reduced volatility. This distinguishes Dividend Aristocrats from rising stocks. If a company can maintain a steady level of dividend payments, that can save them from drowning when something goes wrong. When the quotes decline, dividend yield becomes too tasty and the shares are immediately bought back. But in this case, unfortunately, you can't expect explosive growth of quotations. In such stocks, there will be no increased sentiment as in the case of Tesla. There will be no speculations and there will be no takeaways to disperse the price. Now, it's time to talk about some disadvantages of investing in Dividend Aristocrats. The disadvantages of Dividend Aristocrats are in some ways related. In a portfolio that consists only of Dividend Aristocrats, you will see weak structure, diversification, and technology. So let's have a look at it in more detail. If we divide the Dividend Aristocrats into sectors, here are the sectors that will have the maximum weight. Okay, and those are consumer staples, industrials, and materials. And the sectors with the lowest share will be IT and communication services. You can see that those proportions do not correspond with the spirit of time. They have a very low technological efficiency. But, as you might guess, it is IT and information services that are going to be the biggest player on the market in the future. If we plan our portfolio strategically and we want to play for long term, for 10 to 20 years, we need to make sure that we rely on those companies that will not become irrelevant in the new technological era. In addition, the products of technology companies have a large added value, which provides businesses with a large margin. Already, two technology sectors, IT and healthcare, together make up 40% of the S&P 500 index. This graph shows how these two sectors have grown over the last 10 years. You can see the trend towards a new technological order if you study the S&P 500 index over the last business cycle. And here you can see those sectors that have lost their weight since 2009. Those are largely commodities, products with low added value. Oil and gas have almost completely collapsed over that period of time. All this means that in a good portfolio, in addition to good dividends, there must be some growing securities. Another thing that we need to consider is the life cycle of enterprises. Companies and businesses are like humans. They are born, they raise to their feet, they have their best days, they lose their health, and then they die. Some companies become true centenarians if they accept the rules of their time, and thus they can remain afloat. When someone builds their portfolio on the Dividend Aristocrats, they by and large bet on the old guard. Yes, those are reliable and there is very low risk of losing money, but at the same time, those companies do not have almost any potential for growth. If a company starts sharing their profits very generously, it means that that company has exhausted all its potential for growth. And vice versa. If a company is growing very quickly, it is not very likely to share its profits. It is more likely to invest them into future growth and expansion. If you invest in a fast-growing company, you prefer that the profits of that company stay in it and the company uses it for financial leverage. If the company does it, its indicators will grow and that will affect the quotes. In this case, the profit that you will make because of the growth of assets will be much higher than the profit that you will make of dividends. Well, I gotta mention that there are different kinds of investors. Some rely on passive income, and for those people, passive income from dividend payments is pretty good. But that is more about those people who are of pre-retirement or retirement age. And in this case, the conservative approach to investing is very fit and fully justified. But if you are a young, hip, and cool investor who is only starting out and who is ready to play for long term and who does not need passive income right now, in this case, it is better to invest in those companies that are growing and those companies that will mature with the investor. Over time, the explosive growth of those companies will be exhausted and they will move to a more generous dividend policy. And, that's a win-win. First they grow and then they give you good dividends. Yay! Okay, let's map. Dividend Aristocrats are great if you need your passive income right here, right now. But if you want to look into the future, you might want to diversify your portfolio with some growing assets. That's our advice to you. Do what you gotta do. I'm not pushing you towards anything. Subscribe to our channel. Okay, this is it for today. Like, subscribe, leave a comment, and ring the bell. Make money, multiply money, and be happy. And remember, the world is not all about money, but about its quantity. I will see you next time.